After investing $12.50 per week total into dividend-paying stocks, our classroom portfolio has an annual return of 20.38% and has grown to $1,927.34 after 119 weeks. Hi, Professor Rex here. We are now a little over 2 years into our class project where we take $12.50 per week and split it up to buy 10 different dividend-paying stocks. The market finally seems to be taking a breather, which is a good thing because many stocks are getting a bit expensive compared to their future earnings streams. We should be seeing some better bargains next week. If you're new to my channel, I teach college accounting, and I often show my students how to use the accounting concepts that I teach to pick stocks because it grabs the attention of my students and gets them engaged. To show them accounting concepts in action, starting a little over 2 years ago, each Monday I invest actual real-world money, $12.50 per week, which is roughly the equivalent of $50 each month, into 10 different dividend-paying stocks. And because those original students are no longer in my class, I decided to make this video series to let them know how our portfolio is doing. There are timestamp links in the description of the video in case you want to jump to the list of stocks we bought this week, or the list of our best performers, or any other section of the video. This week I added a slide for the 10 stocks we bought a year ago. We get to see how they've done. In 2022, the year we started the portfolio, the market did not perform well, but because I don't believe in trying to time the market, we kept buying each week at what turned out to be great prices. Then last year in 2023, stocks took off. Currently, the portfolio's value is over $1,927. The return has been 20.38% per year, which is higher than the S&P 500. Last year, the portfolio's return was 28.6%, which also beat the S&P 500. And in the preceding year, the portfolio once again beat the market. So why do we only invest in dividend-paying stocks in this portfolio? That's explained on the next slide. The first reason we stick with dividend-paying stocks is, according to a Hartford study, which was just updated, over the past 50 years, dividend-paying stocks vastly outperform non-dividend-paying stocks. The total return for dividend-paying stocks has been 9.17% per year, but for non-dividend-paying stocks, the average return has been much lower at 4.27%. The study is updated each year, and as I said, it's recently updated. So you can go check out the source link if you want to know more information. The source link is at the bottom of the screen. Maybe more importantly, historically, dividend-paying stocks have less volatility than non-dividend-paying stocks. It's much easier to stick with a less volatile investing strategy. The more volatile a strategy is, the more likely you are to panic and sell at the wrong time. So why are dividend-paying stocks less volatile? Because most dividend-paying companies are making a profit, which is why they have excess cash to pay back to investors. As you can see on the screen, risk and volatility of dividend-paying stocks as measured by beta and standard deviation tend to be much lower for dividend-paying stocks. That means they're less volatile, less risky. And finally, the study also showed that the best performing stocks are dividend-paying stocks that increase their dividends, which is why our classroom portfolio only invests in dividend-paying stocks that have increased their dividend recently. So why did we choose to invest $12.50 per week, which is essentially the same as $25 per paycheck? The next slide explains that. The main reason why we invest only $12.50 per week into the portfolio is because I wanted to show my accounting students that you do not need a lot of money to build a diversified stock portfolio. In fact, when I was only making $11,000 per year as an enlisted member of the military, I started my investing journey with only $25 per paycheck. In other words, the equivalent of $12.50 per week. And because my brokerage account, Fidelity, allows me to buy as little as $1 per stock, we can quickly and easily create a diversified stock portfolio with little money. Originally, I invested $25 per paycheck in this portfolio, but found the process to be so fun that I split it up and now invest $12.50 each week. And we boost the contribution once per year by the amount of inflation to replicate the fact that people's paychecks usually increase at least by the amount of inflation every year. By the way, I also invest in these same stocks in my retirement and my taxable brokerage account. The research we discuss in class is the same research I use for myself. Another reason I started with a low investment amount was because one day I was wondering how much a young person, in this case a 17-year-old, needed to invest per week to accumulate $1 million at retirement. And it turns out it's only $11.74 per week. Of course, since most people's annual salary increases each year by the amount of inflation at the very least, I assumed the contributions would increase by 3% each year, which is about the historical rate of inflation. That means in the second year, it's assumed that the person invested an additional 35 cents each week for a total of $12.09 instead of the original $11.74. For a classroom stock portfolio in year 2, we boosted the weekly investment 82 cents for a total of $13.32 per week in the second year. Of course, that's because of inflation. And in year 3, inflation wasn't as high, so we boosted the weekly investment by only 49 cents for a total of $13.81 per week. A very popular exchange-traded fund that only holds dividend stocks is the Schwab U.S. Dividend Equity ETF, ticker SCHD. SCHD is a large holding in my personal accounts, so I've been tracking SCHD's performance closely with our classroom stock portfolio. As of today, our classroom stock portfolio's value is $1927.34. If we had instead invested the same exact amounts on the same days into SCHD, the portfolio's value would only be $1640.85, a difference of 17.5%, which is a bigger lead than we showed in our last video. Obviously, there's no guarantee that our portfolio will keep outperforming SCHD at such a high rate, but I've been gradually selling off my personal SCHD holdings and reinvesting in our classroom stock portfolio. I also prefer our actively managed classroom stock portfolio strategy rather than SCHD's purely algorithmic approach where no one is overseeing the stock selection. SCHD has, at times, had large positions in stocks that I consider to be risky and to be value traps. This slide shows our best performing stocks based on when they were initially purchased. Stocks in yellow have been sold. Lam Research and Broadcom lead the pack. Also remember that total return includes both the dividends the company has paid as well as the increase in stock price. Now let's turn our attention to the strategy column, specifically the category called Dividend-Growth stocks. 90% of our investments made in the portfolio were made in these stocks, which means they are high-quality stocks with a great track record of increasing their dividend payouts to investors. The other 10% of investments so far have been invested into smaller, under-the-radar companies that have recently started paying a dividend. These under-the-radar dividend-paying stocks tend to be riskier because they are smaller companies, but studies have shown that they historically beat the market averages by a significant amount. Before we look at the 10 stocks we bought this week, here are the 10 stocks we bought a year ago along with their total returns, which of course includes dividends. I still own all the stocks in the portfolio except the stocks in yellow. I sold Robert Half to generate additional funds to invest in another stock, and the company seemed to be close to fairly valued at the time. And I sold Fidelity National because they cut their dividend. This is usually a very bad sign, but we still made a 28.5% profit in less than a year. Now let's talk about the 10 dividend-paying stocks we bought this week. Here are my ratings for the top 11 dividend-paying stocks this past week. I show the 11th stock, Microsoft, just to let you know what company just barely missed the cutoff. Remember, each week we buy 10 stocks, and since we're investing such a small amount each week, it means we are buying fractional shares in our Fidelity brokerage account. This table includes their industry, how undervalued they are according to our research, their risk rating, quality grade, and dividend yield. The two most undervalued stocks this week were Comcast and Lithia Motors. Remember, all these stocks pay a dividend and have recently increased their dividends, and our methodology used here indicates that they are likely to continue to raise dividends. Therefore, this is a dividend growth strategy. On this slide, I want to show the components to my quality grade. Quality-wise, we only invest in stocks rated B- or better for this portfolio for 90% of our purchases. The other 10% so far have been invested in smaller, under-the-radar companies that have recently started paying a dividend. These under-the-radar dividend-paying stocks tend to be riskier because they are smaller companies, but studies have shown that they historically beat the market averages by a significant amount. But this week, all the stocks we bought are high quality and are dividend growth stocks. So we don't have any of the riskier dividend initiating companies. Risk is the first quality component, which we mentioned on the previous slide. The next quality component is competitive advantage. Obviously, the more competitive advantages a company has, the better investment candidate they are. The next quality component attempts to evaluate the company's management. Our evaluation includes both management's use of capital and general decision making, but also our research dives deep into accounting data to look for red flags in the company's accounting practices, as well as the quality or reliability of their reported earnings. And remember, earnings are just another word for profits. And finally, the last quality component is financial health. If you're looking for lower risk stocks, I would suggest American Express, Nike, Apple, and Microsoft out of this list. The companies earning the highest financial health ratings are MasterCard, Visa, Apple, and Microsoft. Remember, historically, the best performing stocks are those that both pay a dividend and have grown their dividend recently. As you can see under the grade called Grade for Recent Dividend Growth and Current Yield, the stocks with the best combination of dividend growth and higher yield are Comcast, Nike, Starbucks, and SiriusXM. Ideally, you want a higher dividend, high recent dividend growth, and the best potential for future dividend growth, but that's not the way it works. Companies that are already paying out higher dividends rarely have the greatest potential for the greatest growth in those dividends. In our list, as you can see from the last grade, dividend growth potential, the companies in the best position to increase their dividends substantially are MasterCard, American Express, and Apple. The companies with the best combination of recent dividend increases and potential of future dividend increases are Comcast, MasterCard, American Express, and Visa. The holy grail of investing in dividend-paying stocks is to have the portfolio generate enough dividends to cover your annual expenses, a level I've reached despite being on a crappy teacher salary. Historically, dividend-paying companies raise their dividends by 5 to 6% per year, which is above the historical rate of inflation. This means a stock portfolio can produce the ultimate passive income stream, that being one that increases each year above the rate of inflation. On this slide, we're looking at stocks in our portfolio that have raised their dividends recently. 17 of our stocks raised their dividend recently by over 10%, led by packaging with a 50% dividend increase. And here's a look at the 10 stocks that make up the largest portion of the portfolio as of Sunday. Remember, we want to build a conservative and diversified portfolio by limiting the amount we invest into one single company. Aggressive investors might not want to limit the investment into any one stock. But I'm a conservative investor, therefore we temporarily stop investing in a company if they make up more than 4% of our portfolio. This leads to a less risky, more diversified portfolio. It's true that our portfolio's returns would likely be higher if we always invested in our top 10 stocks, regardless of the size of the stock's portfolio allocation. But that also creates a more concentrated, more volatile portfolio, and many investors can't psychologically stick with a volatile portfolio. Volatility, as we mentioned, often causes investors to panic and sell at the worst time possible. Now, our portfolio holdings are currently at 89. That might seem like a large number of companies to keep track of, but the spreadsheet we have developed for tracking the companies make it obvious when to sell a company once we download the company financial and accounting information into the spreadsheet, which we do at least weekly and doesn't really take that much time. So those are the companies we bought this week. We're trying other strategies too, using real stock portfolios. Besides this dividend growth strategy, we are also running the following portfolios. A high-yield dividend-paying stock portfolio. This high-yield portfolio currently has a 4.6% yield and is surprisingly beating the S&P 500. I would have thought that a yield that high would not produce enough capital gains to beat the market, but so far it has. Let me know if you want any videos about that portfolio in particular. We have a portfolio with stocks with the best competitive advantages, also called moats. Note that all stocks are eligible for that portfolio, both dividend-paying stocks and non-dividend-paying stocks. And finally, we started a technology-focused portfolio investing in these themes: AI, big data, cloud computing, cybersecurity, software as a service. So in the comments, let me know if you have any questions or if you want to know more about the other portfolios. Also, let me know what kind of other investing videos you'd like to see. And finally, here are the places you can reach me: YouTube, obviously, as well as Twitter/X, LinkedIn, and my website, beatthestockmarket.com. Have a great investing week.